you want to crack the code to your real estate success? Hi, I'm Mark McInerney, President and CEO of CodeMark Financial. And in here, we teach realtors, just like you, how to become mortgage money geniuses. Today, we're talking about loan programs, conventional loan programs. Sit back, relax. 3, 2, 1. Off we go.
I just wanna be your superstar, 'cause it's not where you're from, it's where you are.
All right, so welcome, my friend. So you have been learning quite a bit if you've been following all of the other previous episodes about understanding the value and the importance inside of the entire mortgage game. Because the mortgage game is actually where the entire real estate transaction lives and dies. You know, it's interesting. You speak to most clients and they're going to say, you know, hey, where do you start if you want to purchase a house? And they usually say the realtor. But then the realtor, you, says, why don't you go get pre-approved? Or have you been pre-approved? Or have you been pre-qualified? And we've talked about the differences of that, you know, being pre-qualified and pre-approved. Problem is that this is where sometimes even the realtor, you, well, put so much trust in your mortgage partner to really, well, deliver your commission check. And this is what we want to do here. We want to arm you with the intelligence and the knowledge and the information so that you can be a genius in the space of what actually makes this whole thing hum and close. So, you have seen all of the pieces about the credit, the down payment, the income. Now we're inside of the conversation of the vehicle that, well, your buyer is going to jump into. Is it a conventional loan? Is it an FHA loan? Are they a veteran? Is it a VA loan? Are they buying a big house? Is they going to need a jumbo loan? Are they buying a house out in a rural area, USDA loan? Are they self-employed? Do they need to qualify for what is called non-QM money? Are they an investor? Do they need some hard money, right? You know, hard, you know what I'm talking about. All right, so today we're talking about conventional loans. So what are some of the basics that you need to know about a conventional loan? All right, well, number one, down payment. Well, the minimum down payment, as we film this, is going to be 5%. There are other loans that will allow a borrower as an alternative to FHA, but in the conventional category that would allow a home buyer to maybe put down less, maybe as low as 3%. And the ones that do or would perhaps allow as little as 3%, well, you might want to check with your mortgage professional or us to find out if your buyer would qualify for that kind of, let's say, more of a niche program. But 5% down is what you're looking at, okay? Number two, credit score. The minimum credit score, again, as we film this, that most lenders are going to require is going to be a 640. Now, there are some lenders that will go as low as 620. Now, it's always worth noting, the better your credit, the better your interest rate is going to be. So think of it like this. It's kind of like the opposite scales. The higher your credit, the lower the interest rate. And that is usually what your buyer is most concerned about when they even think about purchasing a house. There's so many other pieces that are always, you know, kind of taking place. But the very first thing they think about is, what is my interest rate going to be? Because interest rate are what are kind of, you know, toted all over the place, especially now on the internet. And when, you know, somebody's looking at their phone and they're getting hit, you know, with ads that say interest rates as low as this. So I go back to the credit score. 640 is the minimum, but in the conventional space, the lenders are going to want to see someone, or a buyer basically, with a credit score of at least 700 or better to get those juicy interest rates. We'll get into interest rates when we start talking about interest rates in some upcoming episodes. Lastly is debt to income, right? So these are all the same three things that we talked about in terms of pre-qualifying someone and pre-approving someone. If you'll notice now kind of the parallel, these are the pieces that are also required inside of the operative loan programs that your buyer is going to qualify for. So that DTI, or debt to income ratio, that is required inside of a conventional loan is going to be 45%, which again means what? Well, whatever your client's monthly income with the debts that they already have, you would add also the proposed mortgage payment, and that full number cannot exceed 45% of what they make monthly. So is this a good or a bad thing? Well, as you'll see in the next couple of episodes here, we're going to go through all of the different loan programs. A conventional loan is fit for certain buyers that qualify for it. Doesn't mean that it's a good or a bad. It's just the program for said buyer or borrower that would fit into this, let's say, mold. The other ones have their own little unique nuances as well. Again, not specific to all home buyers, which is why all of the different loan programs exist. So take a brief moment, check out this slide by my man Freddie that is going to paint out exactly what we've talked about. The three pieces: the down payment, the credit score, and the DTI that is associated with doing a conventional loan. So here's the thing. This whole point that you are here is to learn this part of the business. You know, technology affords me the opportunity to speak to you like this. This would be no different than if you came into this office and into the studio and we had a one-on-one conversation about mortgages and your buyer and how all of that kind of is, packaged together for ultimately your commission check. And yes, of course, ultimately for the mutual benefit of the client for home ownership. But a lot of realtors suffer in the space of being successful in this space because they put so much weight and trust in their mortgage partner. And I'll have you consider, I'm pretty sure you've gone through a lot of mortgage partners, and it shouldn't be that way. You should be working with one and growing in that relationship, being educated along the entire steps and the processes of what it looks like. So not only are you building a relationship of trust, but you in turn are building a relationship of obtaining the knowledge from your mortgage partner so that you can also sound equally lethal in terms of being informative to your buyer and even your seller. And today, most clients have access to this online. And most realtors are trying to figure out their relevance to stay relevant in a game that technology is kind of commoditizing. So how do you do it? Right in here, by becoming a mortgage money genius. With that being said, would you do me a favor, please? Would you like, share, and comment on this? Please, I want to hear your feedback. I'd also like to see that you're enjoying this information. And most importantly, look, I know, as they say, birds of a feather flock together. You've got other colleagues that need to hear this stuff. So share this with them. And in the meantime, we'll continue to work up some really great things to share back with you. I'm Mark McInerney, President, CEO of CodeMark Financial. This has been Mortgage Money Genius. See you.